This Week in Economics on the 25th of March 2018, our last episode of the month of March as we move towards April. This is Numbers Man here with our partner Cranston Analytics, and we'll start to look at the Trump economy as it takes shape from various angles, including the FOMC report, that is, the Federal Open Market Committee. Will start out with it, and then we'll look at the individual states and how they are doing across the continuous U.S. in terms of their personal income percentages. Anyway, we'll start with the Federal Open Markets Committee. I won't read it all here, but we'll look at it. Information received since the Federal Open Markets Committee met in January indicates that the labor market has continued to strengthen and that economic activity has been rising at a moderate rate. The key here is moderate. Job gains have been strong in recent months, and the unemployment rate has stayed low. Recent data suggests that the growth rates of household spending and business fixed investment have moderated from their strong fourth quarter readings. Over a 12-month basis, both the overall inflation and inflation for items food and energy have continued to run below 2%. Market-based measurements of inflation compensation have increased in recent months and have remained low. Survey-based measurements of long-term inflation expectations are little changed on the balance, consistent with the statutory mandate. The committee seeks to foster maximum employment and price stability. The economic outlook has strengthened in recent months. The committee expects that further gradual adjustments in the stance of monetary policy, economic activity will expand at a modest pace in the medium term, and the labor market conditions will remain as strong. Inflation on a 12-month basis is expected to move upward in the coming months and to stabilize around the committee's 2% objective over the medium term and near term. Risk to the economy, to the economic outlook appears roughly balanced, but the committee is monitoring inflation development closely. In view of realizing expected labor market conditions and inflation, the committee decided to raise the target rate for federal funds to 1.5 to 1 3/4%. That was just 25 basis points there. The stance of monetary policy remains accommodative, therefore supporting strong labor market conditions and a sustained return to 2% inflation. That is very important, that the inflation rate in an industrial capitalist economy such as the U.S., you can run the inflation at 2.5% and even at 3%. But given the present trends, and we'll start looking at those, the likelihood, I should say, of your GDP running at, say, 3 or 5% as suggested by one of DJ Trump's advisors, is not realistic. Now, could that be an outlier where the GDP would, say, perhaps be at 4%? Not as likely under current economic conditions. More at 2 and 2.5%. That could be 3%, but again, a quarter would not specify the other quarter. Indications are now that that will not occur. And we'll get to why that will be in a second here in determining the timing and size of future adjustments in the target rate for federal funds rate. The committee will assess, realize, and expected economic conditions relative to the objectives of maximum employment and 2% inflation. The committee will carefully monitor and accurately expect inflation development relative to its symmetric inflation goal. The committee expects that economic conditions will evolve in a manner that will warrant further gradual increases in the federal fund rate. The federal fund rate is likely to remain for some time below levels that are expected to prevail in the long run. However, the actual path of a federal fund rate will depend upon economic outlook as informed by incoming data, and that's signed by the chair, Lawrence Powell, and the various other functionaries on that committee. Let's jump over here to state by state. This is personal income percentage changes in 2016 and 2017. Washington State will give just some of these. 4.8%, Oregon 3.3%, California 4.1%, Nevada 4.4%, Arizona 4.3%, Utah 4.4%, and Colorado 4.1%. Wyoming a 1.8%, not as much activity in Wyoming. In Montana 3%. Now, in New Mexico 1.8%, Texas 3.1%, Oklahoma once a bastion of growth 2%. And Kansas 1%. You can see where this is going here. Nebraska 1.4%, South Dakota 1.4%, and a negative 0.3 for North Dakota. And if we go down to Louisiana, 2.9%, Arkansas 3.2%, Missouri 2.1%. This percentage change is just in personal income there, and Iowa just 0.3%. Minnesota 3%, Wisconsin 2.6%, Illinois 1.9%, Michigan 2.6%, Indiana at 3%, Ohio at 2.7%, and Kentucky at 1.6%. Not much growth there. Florida at 3.8%, Georgia also at 3.8%. A little bit of a surprise there. Alabama at 3%, South Carolina at 3%, North Carolina at 3.8% also, Virginia at 3.1%, Pennsylvania 2.8%, and New York at 2.9%, and Vermont at 2.1%, New Hampshire at 3.5%. The Commonwealth of Massachusetts at 3.3%. Rhode Island in New England is usually always behind, but it's 2.4%. Connecticut, surprisingly, at 1.5%. Delaware at 3.7%. New Jersey at 2.5%. Maryland at 3.1%. And D.C. at 3.1%. Sort of an interesting contrast there. Now let's go back here. State personal income increase. This was on the 22nd of March. It was put out. Increased in all states, District of Columbia, except for North Dakota. The percentage change in personal income across all states range, and of course, at 0.3% in North Dakota. Washington State was a bastion there. Earnings increased at 3.1% in 2017. It was a leading contributor to growth in personal income in most states, including the 5 fastest growing states, i.e. Washington, Idaho, Nevada, Utah, and Arizona. Retail trade was a leading contributor to earnings increase in Washington State at 5.2. Retail trade earnings increased 15.3% in Washington, compared with 2.9% the rest of the nation. Durable goods manufacturing was a leader, a contributor to earnings increase in Idaho, 5.3%. Durable goods manufacturing increased at 9.7% in Idaho, compared to 2% the rest of the nation. Construction was a leading contributor to earnings increase in Nevada. A lot of construction going on there, 4.3%. Construction earnings increased at 15.2% in Nevada, compared at 5.2% the rest of the nation. Professional, scientific, technical services was a leading contributor in the state of Utah. 4.7%. Professional, scientific, and technical earnings increased at 7.6% in Utah, compared with 3.7% the rest of the nation. Healthcare was a leading contributor to earnings increase in Arizona. The earnings in healthcare increased at 6.4%, compared with 4.1%. For the nation's earning increased in 22 of the 24 industries for the Bureau of Economic Analysis prepared estimate. Healthcare and social assistance, professional, scientific, technical services, and construction were the leading contributors. Farm earnings decreased at 6.6% in 2017. This was the 4th consecutive annual decrease in farm earnings, and was a leading contributor to slow growth in Kansas, Nebraska, South Dakota, and to decrease in earnings in Iowa and North Dakota. Now we start to see the Trump economy unfold, particularly for the agricultural states. Now, how will the new tariffs affect them? We'll see. But it will not be, as they say, an enhancement, a feature for these agricultural economies. Property income from dividends, interest, and rents increased 3.3% in 2017, after increasing 1.2% in 2016. The percentage change in property income ranged from 4.4% in Washington State to 2.4% in Kentucky. Personal current transfer receipts increased at 3% for the nation in 2017, an increase of 3.1%, after increasing of 3.1%, a little better in 2016. The percentage change in transfer receipts ranged from 8.3% in Louisiana to 1.1% in New Mexico. Fourth quarter personal income increased at 1.1%, the average in the fourth quarter of 2017, after increasing 0.8% growth in the third. The percentage change in personal income across all states ranged from 3.5% in Nevada to 0.2% in North Dakota. So not a lot of improvement, although the energy sector in North Dakota is moving along. But overall income's there because a large percentage of that state has a farm income. Now this will be more interesting, the spotlight on the tariffs, how the tariffs will affect major blocs, including the EU. Now there's some exemptions to the EU in terms of where the tariffs will, as they say, land, and some to Canada. There's a lot of holes like, say, Swiss cheese, which is not a very good economic term. Now let's go on. From the Reuters service, China warns it will defend its own trade interests. Most nations will do that. President Xi was the highest level between the two governments since DJ Trump. Now, this is mentioned announced plans of tariffs up to 60 billion of Chinese goods. Now, this call with Mr. Liu, a Harvard-trained economist, said China will hope both sides will remain rational and work together to keep trade relations stable, and that is the case here. U.S. officials said an 8-month probe under the 1974 Trade Act found that China engaged in unfair trade practices. That's been something that they have been talking about for a very, very long time. The Trump administration responded by telling China to immediately shave $100 billion off of the record $375 billion trade surplus with the U.S. Beijing told Washington that U.S. exports restrictions on some high-tech products are to blame, and there are more of this protectionist type of situation, firing off a warning shot. China declared plans to levy additional duties of up to $3 billion on U.S. imports. Now, that in itself will be a very interesting situation, particularly with the agricultural section. Globe and Times said Beijing will only just begin to look at means to retaliate. We believe it's only part of China's countermeasures. Soybeans, now this is where we get to this, and other farm products that will be targeted. Widely read there in China. Now, from the China Daily, that Beijing will impose tariffs on more U.S. products, is considering a second and even a third list of targets. Now, this is one thing to remember, that a lot of U.S. products go also into China, and these are be regional and state Pacific. Soybeans, that is out of the Midwest and Iowa and those states, has been relatively weak. The economic ministry response. Well, the Chinese are not going to respond in that manner at all. U.S. farm groups have long feared that China would, which imports more than a third of all U.S. soybeans, could slow the purchase. In other words, soybeans would be problematic. U.S. agriculture exports to China stood at $19.6 billion last year, with soybean shipments around $12.4 billion. Chinese penalties on soybeans especially hard hit Iowa, a state that DJ Trump won in the 2016. Oh, actually, they said that. Elections. Ahead of myself here. Beijing jets have been often cited as Boeing, jets have been often cited as targets there, and that would hurt certain states depending on where they are these days. Both countries have benefited by globalism. That is from Larry Fink of BlackRock. It was at a forum. Anyway, nonetheless, Apple called for calm heads. Well, again, the exclusion of smartphones from China from the U.S. market will, in the end, cause China to refactor their trade relations. And for instance, if their phones are not allowed here in the U.S., or some of their telecommunications, Hyundai, who I'm thinking of here, not Hyundai, that's in Korea. Anyway, nonetheless, they will find other markets to make up to it if it's only a piecemeal situation. So that we can expect to happen, and that is over time. 2018, we'll go back and we'll look at the soybeans and see where they are in terms of Iowa. Those are some of the things that we'll see more and more of. Let's go to Bloomberg, and then we'll come back to Facebook and what's happening there also. A hard week for the Dow. This is from Bloomberg. Investors begging for Trump respite. Stocks extended a slump in the afternoon, trading as selling took hold. The Dow posted its third dip of 5% in the past 2 months, and 6% prior to that. Spring has sprung, but not in the U.S. stock market here, which had a hurrying week. With traded equals of what they call a correction in February. In the past 5 years, there has been only 2 stretches with losses of this magnitude. The S&P 500 index is down 6%, and the picture looks just as bad for the Dow Industrial Average, which sunk to a 4-month low by Friday's close. Both indexes suffered their steepest weekly drops in more than 2 years. Equities are now teetering near, and for blue chips below levels seen as the worst point in February. The volatility fueled meltdown as the epicenter this time to the U.S. Trump's trade war with China, driving Boeing's stock down more than 5%. So these are what happens. It's a little wider situation. Investors for months had relied on Trump's pro-business rhetoric, are now caught off guard. That's from Matt Maley, equity strategist at Miller Trabeck and Company. Trade tariffs are a big change, and China's response could even get stronger. There isn't much to be optimistic about. Investors' concerns associated with the Trump tariffs, isn't going to be reversed neither next week nor the next week after that. Consider this is a worrying sign of investors' futility. The Dow has closed down lower than the midpoint of its daily range for 10 straight days, the longest stretch since at least 1982. That suggests traders are finding reasons to dump shares in the afternoon rather than buy dips. The Friday slide, the S&P fluctuated from most of the morning before sinking 2.2%. The volatility index jumped 7%, closing a lower to its highest level since early March. Again, the violent moves in equities and other assets classes look relatively tame. Yields on the 10-year treasuries slipped 3 basis points over the week. The dollar lost some ground and gold gained. That's usually the case. Oil ignored the risk off-toned and jumped at appointment of a new national security advisor, heightened the possibility of sanctions against Iran. Well, what happens there? Iran. Anyway, with every sector trading in the red, investors had nowhere to hide. The concerns over the tariffs of 50 million in Chinese goods, actually 60 million, and enrolled industrials and materials company. China has already hit back, unveiling its own level of, as we stated earlier here, billion U.S. in imports. Bank of America, the best performing big bank stock since the election, tumbled of DJ Trump, tumbled 9.3%. Facebook plunged 14% in the throes of a privacy scandal. Now, what happens in the tech sector with Facebook is very interesting, but that sector had artificially held up, particularly the NASDAQ, for the last several months. Now the artificiality is coming out. Now, the only exception to this is the energy sector. Now, the idea of sanctions creating a false market in terms of petroleum products itself is very interesting, but that will eventually hit the pump price in the U.S. as those go up. So it's a two-sided coin situation, uncertainty around how the tariffs will be implemented, have analysts staying quiet on what will happen to earnings. But it's shaping up to be a big risk to watch, no doubt about that. Bumper profits underpin the market jump in January, but January was an outliner, no doubt. Technical levels now at the Fed is talking about 2 more hikes this year, which raises some concern about the pace of economic expansion. That is from Paulson here. Aggressive, forward-looking Fed tightening policy is something the market will need some time to adjust to, no doubt about that. The Dow a loss of 5.7%, leaving 5%. Just a second here. Below the level where it was before Congress passed the sweeping tax overhaul. Well, the tax overhaul is one of those things that immediately after it, in other words, in January after it passed, we started to see the effects of it. But those effects are not long-lasting. We're in Q1 right now, but in Q2 and Q3 we'll look back at that. That the corporations had already taken advantage. They've got the tax savings. Some of the workers got bonuses. Some others got some raises. Will they get future raises, say, in Q4 and Q1 of 2019? That is all debatable. And with inflation, particularly, they leave energy prices out, but that does not mean the consumer will not see it. The S&P 500 closed at 2582, hovering above its 200-day moving average. Small caps that don't rely on foreign sales as much as their larger parts did. Peers did slightly better, sliding 4.8%. And the NASDAQ 100 sunk 7.3%. The S&P decline since March the 9th was its third clip of at least 5% in 2 months. Before the last time the gauge lost that much was in June of 2016 when the Brexit vote of the EU. So in other words, these are some of the real things we're looking at. Now let me go to the BBC and the Facebook story. Now it plunged $58 billion on 2008 election related episode at the Cambridge Analytica. Now, what is happening there? There are campaigns now to delete Facebook, and how this will affect other things. Shares in the social media company fell from $176 on Monday to around $159.30. Friday night, will the shares recover? Facebook's initial public offering, looking back at that, it was at $38, giving the company a valuation of $104 billion. Following a stellar user growth and a dominant space in digital advertising, and that will be a big question there. Shares price climbed to $190 by February of this year. Now, an analyst at the Pivotal Research, Brian Wizard, said he has one of the most negative outlooks for Facebook shares price on Wall Street. I have around, this is Wizard talking here, $152 target for 2008, and that was broken this week. So, in other words, shares of Facebook are down, and will be down more because again, the Cambridge Analytica is making more news. Their CEO, Mr. Nix, has been removed, and more revelations about them and their parent company are coming out on a daily basis. And Zuckerberg's testimony before Congress will do little. Part of the problem is Facebook is social media, but it is primarily an ad house. They are hawking ads to whomever. And to remain profitable, they have to continue to offer these ads. Now, if their analytics, based on their algorithms, are being forced to change, that will already mean a less probability for Facebook, and these delete Facebook campaigns, if they really start to take hold. And it doesn't mean very much. We're talking about perhaps 5, even 10% of Facebook users delete. Now, there are a lot of Facebook users that do not use Facebook very much. And Tesla has moved off of Facebook. How many corporations move off of Facebook? Well, that is one to be looked at. And more importantly, the rest of the world market for Facebook. Particularly in the EU, the EU are very concerned about Facebook to be limited there. Facebook just cannot simply grow in North America. They have to find other markets, or they are relegated to relative prices. And we're just looking at some of the plummet here since the Cambridge Analytica. They were at 190, 195. Now they're down 160 on the 22nd. We'll put this graphic up. Actually, we'll append this. Advertising from founding director Kershaw here said the revelation that the 2014 Facebook quiz essentially harvested data from users and of their connected friends without their consent has led to a backlash from advertisers. More shenanigans, as they'd say. Clients have come to the point, quite rightly, where enough is enough, Mr. Kershaw said. Advertisers, Mozilla, Comer Bank suspended ads on the platform, so did Elon Musk. The official Facebook page of Tesla and SpaceX were deleted. Make no mistake, Facebook is an amazing medium for advertisers. The point of view because of the accuracy of its targeting when it comes from data. But I think these large companies are very nervous to be associated with a medium where the data is being abused, particularly in a political context, Mr. Kershaw said. Kershaw told the BBC any changes in the Facebook data protection policy was more likely to come from the threat of withdrawal of hard money from advertisers than consumers running hashtag campaigns on Twitter referring to delete Facebook, boycott Facebook. Hashtags have become popular. UK advertising group ISBA mentioned Facebook on Friday, saying that it's constructive and challenging. Summit has convinced the group that the social media company was taking steps to rapidly address public and advertisers' concern. It will take some time before it becomes clear if all advertising interests dissatisfaction with Facebook leads to their actually pulling money out of Facebook. As far as Zuckerberg reassuring people, well, that in itself is, we'll wait to see. We can say, and this is an economics program, that Zuckerberg's presidential ambitions are shelved for the time. And a lot of this will depend not only on where Cambridge Analytica goes, but of Facebook's former campaigns, of Facebook's discriminatory practices against certain groups, with Facebook's gender discrimination there also. Technology writer Kate Bevan said the week's events have woken Facebook users to the fact that the platform's games, puzzles, and apps have harvested their data for more serious intents. This week's feels to me like a real light bulb moment where people are understanding that it's just not clicking likes on Facebook. It's giving your data away. And this is something that the state sentiment echoed from the European Union's Commission for Justice, Consumers, and Gender Equity. There said that Cambridge Analytica has been a wake-up call. So this is a very big situation for Facebook. Let me just check the time here as we run along. We're running moderately. We'll go ahead and do the numbers here. The BBC Global 30 was off to 219.84 in the negative. The FTSE All Share was off 16.23. In Amsterdam, they were off 6.92. In Frankfurt, the DAC was off 213.77. In France, negative 71.99. In Brussels, negative 41.54. In Madrid, negative 94.30. In Zurich, negative 68.79. These are all on Friday, incidentally. In Moscow, a negative 0.23. In Johannesburg, they were off 294.82. In Bombay, they were off 409.73. In Karachi on Thursday, 384.27 in the positive range. In Lahore on Friday, negative 45.11. In Colombo, a negative 7.76. In Tehran on Monday, 470.40. That's in the positive. In Sydney on Friday, negative 114.20. The Nikkei at a negative 974.31. You can see the effects there of the tariffs. And in Hong Kong, the Hang Seng at a negative 761.76. And in Shanghai, a negative 110.27. In New York, a negative 424.69 on Friday. The Nasdaq was off 174.01. The Merck, that's the commodities market out in the Midwest city of Chicago, negative 55.43. In São Paulo on Monday, 1046.7. And in Mexico on Friday, a negative 648.42. Yeah. Let's see if I can get my glasses out here. Now we go to commodities. The Brent crude futures were up $1.42 at $70.33. The spot was up $2.05 at $63.83. West Texas Intermediate, some call the new benchmark, or they want to be anyway, at $65.78. T-Boone Pickens is jumping for joy even in his retirement. Gold was up $13.50 at $1,342.35. Dubai gold futures was up $18.20 at $1,347.40. Silver was up 1 penny at $16.53. And we go to Unex Life futures. Cocoa was down 384. And coffee was down 61. And the Bloomberg Commodity Index on Friday at 350 was at 87.44. So it was up and down day depending on which commodities you were. Some of the commodities, cocoa, corn, were all down. Coffee was down. The oil, petroleum was up at 70. Remember, at one time, those futures stood at 100. We haven't seen those days. But however, this particular 70 here is very interesting in itself. Oil producing countries, we're thinking of Nigeria, the Russian Federation, Venezuela, even Iran, into a certain, anyway, we won't go into some of those, but they will have more revenue. Now, if there is a quote-unquote sanctions on Iran, then the price will go up. But it will eventually, these are futures, they will eventually translate to the gas tank in the U.S. in time for the summer driving season. Now what that does is on the other side, as it has before, we have a real-time lesson for this. This is not theoretical. But we'll see less consumer discretionary funds. How that will affect the vacation holiday season, we'll see. Those are kinds of things that one place in the economy things are up, another place in the economy things are down. Did we look at corn here while we're here? I think we. Corn, we usually don't. It was just $1. Did we even look at soybeans? I'm not even sure. We don't look at those as much. But that was the Iowa package there. We don't even have it. Do we have it? No. Well, the only thing we have for soybeans, we don't really have very much for soybeans. Seaboat futures at 35.15. Not a lot of movement there, so we kind of have to hold off on that one. The dollar is incidentally down, so there are some things that we do know that are occurring out here. And I was looking back at the Reuters report here, and see if we have just one little second here. And the S&P was off 2.10. The Dow was off 1.77. And the FTSE 100 was off, these are all negative 0.444. The Nikkei was off 4.15. So there's a basket of the markets where they were. And again, the volatility index was obviously up. And we start looking at sectors here that were hard hit, I should say. Energy was down 5.6. This is from Reuters, incidentally. Basic materials were down 1.63%. Industrials were down 1.96%. Cyclical goods and services were down 1.89%. Financials were down, and they were hard hit, 2.24. Healthcare was down 1.91. Technology's hard hit on Facebook. They've been sort of one of the reliable sectors this year at 2.59. Telecoms were down not as much at 1.36. Utilities off 0.79. Now we'll be looking at more and more of these situations as far as to where they will go as the current economy starts to settle in. And we're talking about the Trump economy. Now we're only in Q1. You look at Q2, and Q2 particularly being a transition period, spring in there, in January through March, and then April, May, and June, and then the summer time to see where the economy is going and where the trade will be going. Now, we used to look at things, for instance, the toy market and that sort of thing. Toys R Us has went into bankruptcy and liquidated. There are demographic situations. There are also less children to play with the toys. That's a simple way of putting it. And the influence of other things. In mature markets, as far as headsets or mobile phones, that will impact on Apple. Apple is coming now with cheaper iPads, etc. But will that help? And of course, again, with the Chinese situation, compounding everything else. And once these moves are made, it's very difficult to get the genie back in the bottle. This is the practical side and the psychology of the market. Now, much more important than anything else. For those that recall the Obama years, as we came out of the Depression in the U.S. and on a global basis, the economy was moving on, creating jobs, etc. But on the political side, the economy in the U.S. was talked down, thus a negative or pessimistic atmosphere on Wall Street for the most part, although the banks were making record profits. It's sort of like when the tax cuts came, financials did well, obviously, because of the tax cut. But that is one of the things when these enterprises cash in, then we immediately come back, quote unquote, to earth, where that has happened. Now we're moving towards April 15th, the close of tax season. Consumers will start receiving refunds, and some already have. But those will wind down basically by June, that have not already materialized. And as far as workers' paychecks are concerned, the additional $25 or $50 per paycheck will become routine. And once that happens, and if we get pump price increases, that will eat that up. So we're kind of looking at a mixed bag, and we'll see where that goes. And particularly the farm states are hit hard now. We're hit hard in 2017, and 2018 does not look any better given the tariffs. This will do it for us, for those in business. Make it a productive week for the consumer. Obviously, the eyes are on the prize, and that's basically it. From WBRN Radio and on the Bostonred Network, this has been This Week in Economics by Numbers Man and our analytics partner, Cranston Analytics.